Hey everybody, this is Scott Arnell, and welcome to this episode of the SRI 360 podcast, where it is my job to interview world-class, sustainable, and responsible investors, executives, or entrepreneurs who are driving positive change in the world while achieving market returns. And I do this to bring you the lessons that they've learned along the way from their investment activities and their experiences, and to find out exactly what they are actually doing and how they're doing it so that you can have better insights into the different SRI investing strategies that are actually being done today, what they're actually doing right now, and how they're doing it across many different asset classes. And hopefully, this will help you invest in a more purposeful way and to invest for positive impact for a better world through your investment activities. You've been based in Geneva a while, right?
It's been 21 years now.
I'm even longer than you. I'm over 30 now.
Okay, good for you. It's a nice place to be located and headquartered, I think, and to live with family.
But you're not from Geneva?
No. Originally, I'm from Belgium, and
Okay.
I worked in different places before coming to Geneva. But I came actually when I got a consulting contract from UNCTAD, and I came here in '99. What was originally intended for 3 months, which turned to be 6, and then 9, and then 1 year. And then after that 1 year, I created, BlueOrchard, and then I stayed. And,
Okay. You mentioned you were raised in Belgium. Were you in Brussels, or were you in Ghent, or where were you?
So for the first 6 years of my life, I was in the DRC, in Kinshasa. My parents were teachers and professors at university in Kinshasa back then. And we came back to Belgium when I was 7 years old. But my father is from Antwerp, my mother is from Namur. But they decided to locate and to move to the southern part of Belgium, in the province of Luxembourg, where my father actually started a university there. And so I grew up for 12 years in the countryside of Belgium, in the southern part, in the Ardennes. Went to university in Namur, in the Jesuit University, doing economics and development economics. And maybe important to mention is that when I was 20 years old, that was in the third year of university, I took a trip to India for the first time outside Europe. And I was with a small group of students, and we went and spent 2 months in Calcutta. We visited the places that Mother Teresa was managing. And, we were faced with, for the very first time, at least in my life, with abject poverty. And when you're a 20-year-old and you study development economics, of course, this impacts you a lot. And I think that the real journey started there. The realization that the world is not fair, that there are many problems, many people suffering, and, being privileged with an education that somehow doing something about it was important. Then I continued, my studies, and had the chance of being recruited through one of my economics professor at Namur, in a small consulting company that sent me to Romania, to Bucharest, just after Ceaușescu's fall. And it was quite an experience. I was a junior economist and basically crunching numbers in a small team of economists. But the experience of living in Bucharest at the time was very fascinating. They were just coming out of decades of communism and scrambling to get ready to be included in the Western European markets. So, as you can imagine, lots of challenges, and we don't have the time to discuss this, but it was a great experience. And but I realized that when doing that, just being an economist would force me to remain an academic, or remain someone who would be crunching numbers or writing papers. And I felt that I wanted to do more, be more active. And I then applied to a few MBA schools in the US and was accepted at Wharton, which was a great door opener and a great institution to learn. And so I met my 2 years at Wharton and got recruited by McKinsey just after that. And I spent my couple of years at McKinsey Brussels. And that was another fantastic experience, learned a lot, met many brilliant people. I actually learned a tremendous amount of things. And already at the time, most of my engagements I was staffed on were banking engagements. And I got also the chance of, since I was back then a fast track junior consultant, I could choose once in a while the engagements I would be staffed on. And so I decided to go to emerging markets. So I was in South Africa, I was in India, I was in Venezuela, I was in Argentina, and then came back. And then the calling of my 20-year-old exposure to India came back, and decided to take the job of CEO of a microfinance foundation in Argentina. And did that for a year, and came back to Europe and had the great fortune of, again through McKinsey, knowing someone here in Geneva, Franck Grosel, who was then at UNCTAD working on microfinance and basically the mapping of microfinance globally, supply, demand, support network, and he recruited me to help him with that. So I moved to Geneva, and it was a great year because Franck is a brilliant mind, was truly a forward thinker, taught me a lot. And in that year that I spent with him, he actually one day gave me a 2-page paper about the creation of a for-profit specialized asset management company for impact. I remember that when he shared that with me, I said, well, this guy's nuts, right? What is he thinking about? But I kept the 2-page paper, and then thanks to him, also got a job with Dexia Asset Management that had just started with him the first microfinance fund, and then they recruited me to manage it, and that was here in Geneva with a great team that was starting on emerging markets. And I started managing the seed money we had received from Banque Internationale à Luxembourg, BIL, back then. And André Roulans, who was the chairman, was very supportive of that. So I managed that money. I invested that money.
How big was the first seed money?
That was $10 million. So a small seed money, but still, we could do something with it.
At this point, you were working for Dexia?
Yeah, for a year, managing the Dexia Microcredit Fund. And after that year, basically, I was traveling 75% of my time. I had placed the 10 million, and I wanted more money in the fund, and I wanted some help. So I went to see Bernard Herman, who was the CEO of Dexia Asset Management at the time, a very nice guy who actually recruited me and trusted me. And that's thanks to him that I believe I'm doing what I'm doing right now. But I went to see him and I said, Bernard, I need some help because it's really tough. And he said, look, you're managing 10 million. It's a small amount of money, and we have no resources to recruit more people for what you're doing. Which was fair, which was actually very logical on his side. And then I remember the 2-pager that Franck Grosel had shared with me, and I thought about it, and I then asked them, will you let me go? I create a company, which would be an asset management company, or that would be focusing on the type of things that we're doing for you, microfinance. But please give me an advisory contract on the fund, right? So you remain the fund manager. I became your advisor. And so you don't have any headaches anymore with me asking you all the time things that are not standard in the bank. And he said yes, which was actually amazing. So that's how BlueOrchard started. I started with Cédric Lombard, whom I had met with Franck Grosel at UNCTAD. And the two of us decided to start BlueOrchard. And we had the good fortune of actually starting BlueOrchard with an advisory mandate of the $10 million of Dexia Asset Management, which was enabling our startup to already have a very steady stream of revenues from day one, which is very comfortable. And then we started growing, and that's how the whole adventure started.
And who was your partner at the time?
Cédric Lombard. Great partner, fantastic, same spirit as I had. We shared this, this ideal and this ambition and motivation that we could use private capital as a force for good. And that from day one, we really decided that we would be true to impact, but also that we would be managing that money professionally so that we could attract private investors looking for financial returns and impacts. That's been the DNA of BlueOrchard and then Bamboo since day one. Yeah, we started with, 10 million seed money from Dexia that we inherited from the fund with the advisory contract. And then we grew that. I think by the time I left activities in 2012, 2013 at BlueOrchard, we were close to $1 billion. So that was a decade to go from 10 to $1 billion. Yeah.
So you were there roughly a decade. And those were some interesting times, right? 2001 was already a meltdown,
yes,
in the telecoms area. And then we thought we got through all that. And then 2008, 2009, I think, and in Geneva, I think 2009 was probably the worst.
What we were doing was so niche, so specific, and actually so decorrelated from everything that was happening that we didn't suffer at that moment. Maybe it was actually a chance because people were realizing that maybe what had been done in the past was not necessarily the most sustainable way of managing money. I don't know. Frankly, I never thought that this impacted our efforts at BlueOrchard or at Bamboo.
Not on the fundraising side either, because who
No.
the hell was investing in those years?
Well, believe it or not, we were supported early on by essentially Dutch pension funds, very large ones.
Yeah.
Very large ones, very forward-looking. We were helped, of course, by some people who knew them. But positioning of BlueOrchard in terms of fundraising as at the beginning and always, and still is, I suppose, was always being private sector investors. We want to attract. We don't want philanthropists. We don't want international organizations. We want pure private investors, institutional and private individuals. And I think we were successful in growing the assets. The flagship was the Dexia Microcredit Fund that became the BlueOrchard Microfinance Fund. And I think it was rather appealing because there was a high liquidity, small, minimum tickets, highly diversified, and slowly people started realizing that default rates on microfinance portfolios are actually very low. I know it can be counterintuitive if you don't know about microfinance and lending to poor people, but it's a fact. And so that was a solid track record we could build in, and then we grew the assets.
That was an interesting period to start an interesting business and to grow it.
I think when you're young and motivated and focused, and you know that what you're doing is the right thing, you don't wait for the right moment, you just go. Otherwise, you never do it.
Yeah. And when you're young, you also don't necessarily see all the risks and how hard some of it's going to be.
And frankly, Scott, it was not just a job, right? It's a mission. And when you follow your mission in life, there's no downside.
You've dedicated most of your career to the development of the impact investing field, of which you rightly are considered to be a global pioneer. Your website says, and I'm quoting, your work objectives are driven by deeply rooted faith and values and ambition to contribute to solving at scale some of the most critical problems of our planet. So can you tell me about that, and what are these deeply rooted faith and values? When did you know all of this or discover all of this?
It's a slow maturation process, and when I look back, I think you see many changes in what I did, but I think it all somehow participated in giving me the tools that allowed me to do what I did during the past 20 years. My education has been one of always, from my parents, one of always caring about others. And yes, it's a faith decision that drives me all along. I believe in God. I'm Christian, and I deeply believe that you have received talents that you need to bring to fruition for the benefit of others. That's what I really believe in. And St. Paul is talking about the body of the church, or the body of the Christ, as being composed of many small elements or cells, and we are each a cell. And just like for our body, each cell has to perform its function, its role, and all cells have to take care of each other so that the body works. That's really how I see it, and how I try to live my life.
You founded Bamboo around 2007. Do I have that date right?
Yes.
All right. And you did it in parallel while still at BlueOrchard. So what led you to found Bamboo and ultimately leave BlueOrchard?
Very simple. In 2007, that's 6 years after starting BlueOrchard, I had the instinct that just doing microfinance was great, but was not enough. And that besides doing fixed income, so private debt in microfinance, the banks or the financial institutions we were serving were progressively becoming more regulated, bigger, and needed to capitalize themselves, right? So the first reaction was we need private equity, not only private debt. The second thinking was if we can do that in financial services, then there's no reason why we would not be able to find sustainable businesses in other sectors that would serve the same population. When you think about it, very poor people in the middle of India, giving them access as small micro entrepreneurs to some sort of finance is great, right? And it's impactful. But their families need access to education, to healthcare, to clean energy, to housing. And you don't solve the poverty problem if you don't take a holistic approach and an ecosystem approach to this poverty. And then I thought, okay, I'd love to try and invest in other sectors, in companies, risky companies, non-proven companies, that's for sure, but that are trying to bring essential services to the very same people we're serving through microfinance. And then I was really convinced of that. It was not a proven business. It was not a proven case. And then the board of BlueOrchard, rightly so probably, said, Jean-Philippe, this is too soon. This is too early. This is too risky. We need to focus on microfinance debt. And that's what we're going to do. And I said, please allow me to start Bamboo then on my own, with my own money on the side. And I promise I will not bother you too much with it. And I'll do my best. And they said yes. And then I started Bamboo with my own money and then raised my first fund from this time, mostly private wealthy individuals that believed that I was able to do that for microfinance and maybe I would be able to do that for other sectors. And they trusted me. And I was very frank with them and said, look, I don't know. I don't know what sector, I don't know what geography, but I'm going to do my best. And for sure, we are going to have some serious positive impact. Now, financially speaking, frankly, I don't know. That's risky. And then I raised what I call the Oasis Fund, which was a very pioneer prototype fund with $50+ million from very wealthy individuals that trusted me. And I still owe them a lot because they allowed me to start Bamboo.
So then how did that happen that you left BlueOrchard and just to focus only on Bamboo?
Well, that's a long story and one that I don't like to tell. But in summary, there was an attempt to bring under one roof all the initiatives that I had started, the microfinance, private equity, and the other sectors' activities, and we could not agree on how this would be structured and how this would be governed. And then the decision was either I stop what I'm doing now, and then I agree, and then I'm a good boy and I follow, or we part ways. And I decided to part ways because I believed that there was more in what I was doing than just doing microfinance. And that's it. And so that's very simple. And then we parted ways. They kept the brand BlueOrchard. I kept the brand Bamboo. They kept the microfinance private debt activity, and I did the private equity and the other sectors, and that's it. And then we went our own way, and I'm actually very happy that BlueOrchard succeeded and had this deal now with Schroders, and that they keep growing. I think it's just amazing, and I think it's fantastic because it's, in the end, it's also my baby. It keeps being very impactful and it's now sizable.
So can you describe at a high level what Bamboo Capital is and what it's doing, what your mission is, and your macro focus, and then maybe an introduction into your 5 funds?
Sure, I'll do my best to be succinct. But first of all, I think it's important, Scott, to understand what we mean by impact investing. Okay, very briefly. Many people talk about responsible investing is basically saying, I'm going to invest by excluding things I believe are harmful, drugs, weapons, oil, maybe, and I'm doing something good because I'm responsible. I'm just not doing harmful things. Then you have the next step, which is I'm doing sustainable investment. So it's one step further. It's not only do I exclude things that I believe are harmful for society or for the planet, I'm going to invest in companies that behave quite nicely for environment, for social reasons, for the governance. They're transparent, they pay their taxes, they treat their employees and their suppliers. I'm trying to do my best. Okay, good. But then you not only do you have the responsible investors and the sustainable investors, now you have the impact investors. And impact investors are saying, not only do I want to invest in companies that are behaving well, but I want to solve a problem that I have identified. And I'm going to proactively and intentionally direct my capital to those companies that I believe will be solving that problem. So it's a more active way of investing for impact. Okay. Now, what do? We are emerging market investors. Globally emerging markets. So we invest in Asia, Africa, Latin America, where we have offices in Bogota, in Kenya, in Singapore. Those are our 3 regional platforms. We are a regulated alternative investment fund manager in Luxembourg. We have an office here in Geneva. We have a team of 40 people, and we have deployed so far roughly $500 million in investments in companies active in different sectors. The companies in which we invest are early stage, small companies, SMEs, right? Typically, the investment ticket size would be anywhere between $1 million and $5 million. So that's small scale investment. In equity, they would be either seed stage or series A and B. So we are really focused on this what is called the missing market, the missing middle market segment. We are not investing in growth stage companies. We are not investing $20, $50 million tickets. We are really focused on the SME segment of emerging markets. Okay. We started with microfinance because, as I've been telling you, I had experience in microfinance. So, of course, we started with microfinance private equity and we raised the first fund there. And then I raised another fund on the side that I told you about, the Oasis Fund, to explore pioneer investments in other sectors. That was the Oasis. Now, on that basis, we learned a lot of things, right? We made many mistakes. We did a few good things. And there's one sector that we realized was actually being very impactful and worthy of financial investments, and that was the access to energy sector, specifically the access to solar energy in off-grid markets. So we decided to create another fund specifically on access to solar energy in off-grid markets, and specifically in Africa, that we call the BEAM Fund, and that has been doing great investments. And that's because with the Oasis Fund, we had invested in 6 or 7 access to energy companies, and we saw the different business models, with the mechanics of it, the potential for financial returns for it, and of course, tremendous impact. Now we started deploying and investing in the BEAM Fund, and on that backdrop, we got contacted by the World Bank saying, you seem to be having a decent experience and expertise in managing and investing for access to energy. Will you compete in a request for proposal for electrification of Haiti? And we said, okay, we love the idea of actually pushing, the boundaries and going to Haiti and try to electrify Haiti, which is, as you can imagine, one of the toughest places to do business on the planet.
And getting tougher. Getting tougher
by the day, but well worth the effort. And we won that mandate. And then we won another mandate in Madagascar, where we are also electrifying the island with World Bank money. Now, a couple of years ago, you have to realize I'm moving out of BlueOrchard and I'm by myself, meaning the owner of Bamboo. And then I realized that I was becoming a bottleneck to my own growth, because a key man risk was always flagged by investors. This is Jean-Philippe's business, and what if Jean-Philippe goes? So for that reason and many others, I decided to open up the business to different partners. And my key partner, Florian Kemmerich, joined me in 2016, 2017. And that was an opportunity for me to actually, and for us to actually rethink about the positioning of Bamboo. And we came to the conclusion that opening up Bamboo, given our 10 years of experience in investing in those markets in different sectors, maybe we could position Bamboo as a platform open for partnerships. And effectively, we started responding to requests for proposals from international organizations, because we felt that they had value to bring to the table, and we had the experience of managing difficult environments for early stage companies, which is exactly what they were looking for. So we answered, for example, the International Fund for Agriculture Development request for proposal, and we won that tender, by the way, against BlueOrchard, to actually manage a fund that would be lending money to small scale holders in Africa. And then we won another RFP from the United Nations Capital Development Fund to manage an SME fund for the least developed countries. And then we have structured the partnership, with the International Trade Center and CARE USA to do gender investing. Then we were selected by the Smart Africa Network, which is a group of 31 African states, to manage their Tech for Impact Fund in Africa. And we're now talking to many different additional UN agencies and international organizations willing to come to the field of impact investing, bringing their technical assistance, their knowledge on the ground, their feet on the ground, their thousands of employees, their deal sourcing abilities, but with the rigor and the discipline of the private process of investing. And that's a very strong and very powerful association when you can make it work. And that's the shift that happened with Bamboo business development. We still have our pure private equity funds, the BEAM fund, the fintech fund, a microfinance fund. But we have also now embraced projects with the World Bank that we can manage, and we have also embraced those partnerships with UN organizations, and specifically in blended finance structures. So
okay.
Please interrupt me.
I'm going to interrupt you right now, because you're blowing my head up here. I just want to make sure I understand. You started out with Oasis and BEAM. BEAM. Both of those are energy access funds. So why did you have two separate funds?
Oasis is not only energy. Oasis did investments in access to healthcare, access to housing, access to energy, access to education. And a fraction of the portfolio were those 6, 7 access to energy, businesses. And based on that learning, we created BEAM, which is a fully access to energy fund.
Okay, so Oasis, this was one of your first funds that you started?
Yes, it was launched in between 2007 and 2009 fundraising period as an open-ended fund. And in parallel, we started the Microfinance Project Liability Fund that we raised, I think, $200 million plus from institutional investors on that. Yes.
Is that the Financial Inclusion Fund? Is that the name?
The Bamboo Financial Inclusion Fund. Yeah.
So I guess I got to ask you, how do you come up with these different problems that you're trying to solve with each fund? Do you have a key investor that comes to you and says, look, I'll seed this, and then you go out and raise more? Or
no, it's the opposite. It's the opposite. We see a problem in an emerging market that is essential or that is important to solve. Yeah. We look at whether there are business solutions to that problem. And if we believe that there is enough investable solutions in the markets we're targeting, then we do structure ourselves the investment proposition, and then we sell it to investors. It's not an investor coming to us saying, I'd like you to do this. Now, when we respond to requests for proposals, those are institutions saying, we'd love to do this for small scale holders or for the least developed countries, and we're looking for a manager. And then it's our decision to apply or not apply to that and compete to get that mandate. Those are two different logics.
So the Haiti fund, was that one that the UN came to you?
It was one that we were invited to compete for by the World Bank.
And that's the OGEF, that's Off-Grid Energy Fund.
By the way, first of all, this is a fully funded fund by the government of Haiti and the World Bank. So there are no third-party private investors in it yet. That's a mandate to deploy World Bank money and Haitian government money to develop access to energy, solar access to energy, or mini grids in Haiti. And since we know about those business models, and since we know how we manage a fund, I guess that's why we were selected by the World Bank.
Okay, so you are managing the deployment of capital for these institutions. And then you have another one, OMDF, that's
in Madagascar.
Yeah, so is that also some kind of a mandate? Or?
That's a mandate from the World Bank and the government of Madagascar to manage investments and grants to really grow the sector of access to solar energy across the island.
So then the rest of what you're doing is in this SDG 500, these kind of UN sponsored mandates, right?
That's true. That's because, again, there are two things that are happening in the market that we have embraced. One is a whole range of international NGOs, organizations, and UN agencies are realizing that the pure grant-making business is, to say the least, challenged, and is probably not going to be the one that is sufficient to meet the SDG goals by 2030. That's one. This being said, they have a ton of experience and knowledge and presence, as I said, in those emerging markets, so they are a fantastic partner. The second trend we're seeing in the market is this evolution towards blended finance. And basically blended finance is structured finance using different types of capital into one single pool of assets. And that allows us to go and remain in this missing middle segment, the early stage SMEs, but de-risking such investment for private sector with the use of a first loss, right? So essentially we're saying, instead of having plain vanilla funds where you take the full risk, maybe there's an intelligent way of combining catalytic capital, public money capital, subsidized or risk-taking capital, and put them in the first loss tranche that will take the first hits on the portfolio. And then on the senior tranches or on the senior notes that we would be issuing from those funds, private sector investors looking for a decent risk-adjusted return will be incentivized to come because they are de-risked, they are protected, and the risk-adjusted return is okay for them on a market basis. And that allows for those private investors to take part in truly impactful investments, right? Not doing, as you mentioned, impact washing or greenwashing by paying lip service to some ESG, blah, blah, but really being impactful where the money is most needed while being protected, and that's fine. For the catalytic capital and the public money or the philanthropic money, it's a way of being really efficient, because for every dollar you're putting in the first loss tranche of the fund, that $3 or $4 of private sector money is going to come on top. So you truly catalyze private sector money to the problems you want to solve as a philanthropist or as a public organization. And that's very powerful. And now our association with those UN agencies and international NGOs are allowing us to put this together. And that's the most fascinating trend I've seen over the past 20 years in impact investing.
They're laying in a first loss layer of capital. I've found somewhere in my research it's 140 million in total. Your target is 500 million total. How much have you actually raised?
So we are doing quite well on that. But maybe to come back to the SDG 500 idea and initiative. If you're going to do investments that are on average $2 to $3 million, because that's the sweet spot, that's our positioning, that's our focus. And that's where we believe we are the most, not in the $50 million tickets in some already proven strategies, but really where the rubber hits the road when it comes to helping poor people. So Scott, you don't have a $1 billion fund doing $3 million tickets, correct? That's not manageable. So in essence, we're doomed to manage 40, 50, $100 million funds doing $3 million tickets, correct? Because that's the size that is both sustainable and manageable doing what we're doing. Now, we have realized that in order to be attractive to the true institutional investors, the big guys that are really, they do have the power to move the needle, they will never look at our funds, never. We're too small. The size of our fund is the minimum ticket they would write. So the idea was to say, okay, if we want to remain true to our mission of being an early stage SME investor in tough markets, how do we get to scale? Well, by bundling. And that's the idea behind SDG 500 is to say, okay, the fund we have on small scale holder agribusiness, SMEs in the least developed countries, gender with the International Trade Center and CARE USA, tech for impact with Smart Africa and in Latin America. We are going to bundle those funds. And instead of raising the senior tranches of each of those funds separately, we are going to raise for an SPV for $360 million, and it could be any sort of number. And to raise that money, we are going to actually have a small equity mezzanine in the SPV, and then we are going to issue notes. And we could structure senior notes or subordinated notes that enable private, large institutional investors to actually get an instrument that they can put in their asset allocation. It's a fixed income instrument. That's a note that has been issued by an SPV, and that has a certain coupon or dividend, and that is fully protected not only by the equity mezzanine, but also the first loss tranches of each of the underlying funds. And we are going to place that quickly to institutional investors willing to take bite sizes of 30, 50, $100 million. And their actually money will be flowing to the underlying funds in a very diversified way. And actually, when you think about it, eventually down the line, they will be funding hundreds of SMEs in over 30, 40 emerging markets in a very diversified way, but without taking the pain of going through all those investments. It's just one node purchase at the top. And I'll tell you that when we started this exercise, COVID hit. So that's not been the best environment to raise money, but the concept remains. Now, the funds have been launched separately with their own investors and first losses. We have not succeeded yet in launching this SPV and this series of nodes, but in my opinion, that's the way to go to get to true scale while not abandoning our mission.
So you're going to effectively securitize.
It's not a securitization of existing assets. It's essentially raising money to invest in new asset generation. So we have to be careful with the word securitization, but the principle is that, yes.
Is the same. And the notes are being issued by Bamboo? Or by the
No,
fund?
the notes would be issued by the special purpose vehicle we would be setting up, not by Bamboo itself.
But they're across all the SDG funds. It's not a note for the ABC fund, for example, or something like that.
That's the goal, because we can actually leverage each of our individual funds, right? We are actually receiving money from development finance institutions lending to specific funds if they want to. But the real breakthrough, in my opinion, is if we get to a single note issuance to the institutional market. And that's what we're trying to do. Shall we succeed, frankly, Scott? I don't know. But that's the way to go, in my opinion.
I got to move on here, but I just want to clarify. I get the concept. It's very interesting. I think, if I'm correct, right now you have 1, 2, 3, 4, 5. You have 6 of these SDG 500 funds. Is that right?
We are working on more funds. We've been approached by other UN agencies that have seen what we have done with the first partners we have and are actually keen to partner, let's say, with an impact manager that has cracked the nut of how you organize a partnership between a UN agency and a for-profit asset manager, which is not easy, as you can imagine.
Yeah.
And second, that is also very genuinely interested in the impact and not just paying lip service to impact and sustainable investment. And that is also the experience. We've been around since 2007. And I see those mandates as being extremely promising in terms of their scalability and impact. And as I said, because those partners bring footprint that it would take us a century to have. When you team up with Care USA, you team up with 8,000 employees in more than 90 emerging markets.
Yeah, they got the manpower. There's always the question of focus and delivering outcomes.
And that's what we bring, and the discipline of investment.
You are making direct investments. You are the one who's deploying the capital in direct investments. You don't have intermediaries that you're working through.
Yeah.
Okay. All right. What kind of target returns are you going for?
If you talk about the pure private equity fund, we are in the 15% net IRR target, not much different from any private equity funds. And if we do this, it's because we see business models that can deliver those returns and grow. That's number one. If you talk about private debt, if it's pure private debt, microfinance, you're probably in the single high digit net return. If you do early stage investing in private debt in tough environments, to tell you the truth, we are not capable of charging the interest rate that would reflect the true risk that we're taking. And this is where blended finance come in, right? Because if we can charge a 10% or 11% in dollar equivalent hedged loan to an early stage SME in Kenya, but if you're protected by a first loss tranche that represent 20% of the total AUM of your fund, then I believe that getting a 5, 6, 7% net return in US dollar is a very decent return on your investment, given the fact that you're protected by the first loss and the impact you're having. So to answer your question, typical private equity funds, typical type of returns being targeted. Private debt, pure single strategies of private debt, high single digit. And if you go into the blended finance, senior tranche, probably 5, 6, 7% net returns in US dollars, protected by the first loss. And if you're leveraging those funds on top of the equity that are in the funds, so on top of the first loss and the senior tranche, with loan programs to development finance institutions or whoever would want to buy those notes, you're into 2-3% net return. And that's because you come first in the waterfall and you're being protected by $60 million below you, right?
How do you actually get down to selecting an investment and make your investment decisions? And what kind of screens do you do, both financial and non-financial?
Yeah, I think it's a rather standard process. First of all, on sourcing the deals, we have many different ways of sourcing deals. It can be conferences we're attending, it can be accelerators that contact us, it can be co-investors or people we know, it can be the personal network of our investment managers and fund managers. We source from many different directions. And frankly, sourcing the deals is by far not the bottleneck. What we usually do is a desktop research first to make sure that the portfolio company meets the minimum standards we have per fund, and it depends on fund by fund, and the criteria are different. Very early on and all the way through the process, the impact that the company is trying to have is being checked. Each time we set up a fund, we actually start with what is called the theory of change, right? It is essentially, okay, what is the problem you're trying to solve? How is it that investing in those companies are going to solve or contribute to solving that problem? in order to select those companies, what are the criteria that we need to check so that we're making sure that they benefit and they contribute to solving that problem. And this is embedded in the investment process. So it's very thorough. It takes us weeks and months to prepare that theory of change. And then when it gets put in practice, then of course we have this desktop research. If we believe at our internal risk committee meetings that this company is worth a bit more of our time and money to drill down, we drill down further. There's another risk committee that then decides whether in-person visits to that company is worthy or not. Then we have our investment teams going and kick the tires, on the ground with the team, with the company, on the field, and then they come back with their findings. There's yet another risk committee, and when the risk committee, which is composed of our most senior fund managers, decides that we are ready to present to the investment committee, then we go to the investment committee that makes a decision. It's yes, no, maybe. And if maybe, then we go back to the drawing board. If it's yes, we proceed. And if it's no, well, it's no. We have not invented anything here. We have just embedded the impact screening throughout the process. And at any point in time, we believe that the company is not truly impactful or not aligned on the social mission that we have established for the fund. And even though this would be an exciting financial investment, we're not going to do it.
All right. So could you, just to make it real, describe to me one or two sample investments that you made, and you can pick whichever ones, but maybe something that's the type of investment that you prefer?
Okay, one investment that comes to mind is in the field of access to energy. That's really a technology-focused company. It's a team of 3 graduates from Imperial College that decided they would electrify Africa first and then the rest of the world. It's fantastic to see visionary young business leaders going ambitious on what they're trying to achieve. And they've developed just an amazing technology enabling them remote control of batteries of the solar systems they're placing anywhere in the world, in Africa to start with. This constant monitoring and data capture allows algorithm and artificial intelligence to improve the working of the batteries. They, of course, have coupled that with pay-as-you-go systems, meaning that the households being equipped in the middle of nowhere of Africa with, energy and the solar panels and batteries and appliances can pay as they consume, because usually they don't have the money to pay up front the whole system. And this goes coupled with mobile money and mobile payments through GSM, because of course there's no cash involved in the system. It's really a fascinating business model that is taking off big time. When I say big time, it's really big time. Having a social and economic impact on the poorest populations in Africa is just mind-boggling. And business and financially speaking, this is going to be a very successful company. So that's one kind of example. And then on the more traditional investment side that I've been doing for 20 years now in microfinance, I remain, amazed. For example, in a microfinance bank that we have invested equity in India, that is now managing more than 2 million clients across 13 states in India at an average, loan size of $100. Is the way you manage this, and it's a machine, it's just amazing, and the impact we're having is just amazing, and the IRR we're going to get on these investments is just going to be very high. So I don't know, I could go on and on.
It makes
lots of companies on the ground dealing with poor people.
We can't, of course, discuss this without somehow raising greenwashing or impact washing. How do you avoid that?
If someone is not doing impact washing or greenwashing, that's certainly bamboo. By the sheer investment objectives that we're having, and if you look at our portfolio companies, greenwashing and impact washing happens at the $50 million size tickets, not at the $1 or $2 million size tickets in the trenches in emerging markets. And when you look at the theories of change and the impact assessment criteria and reporting that we're doing on a daily basis and on the reports we're sending to our investors, I would dare to say that we're an example, as opposed to some others that say are impact will do $20, $50 million ticket sizes in very large companies. And the link to true impact is at best vague.
So you're saying that when you're down at the 1 to 2 million, 3 million level, you don't feel that there is risk of greenwashing. Is that because you have your fingers in the due diligence?
Because we have the fingers in the due diligence, and because, as I explained to you in our investment process, that's the first thing we check, right? Yeah. I mean, we're an impact investor. We have a fiduciary responsibility to our investors. In the past, fiduciary responsibility meant I need to deliver the return I promised you. Well, in impact investing, fiduciary responsibility means I have to deliver the social impact and the financial impact that I promised you. And if I'm not equipping my investment process and my teams to actually deliver on those, then I'm a liar.
How do you verify your investments' impact?
Because we're on the ground. Because we're on the ground, because we visit those companies, because we see their clients, because we talk to their clients. And also now, by the partnerships we have with international NGOs and UN agencies, because they do verify that.
How do you measure it, though?
There are two things in impact, as you may know, what we call the output indicators and then the outcomes. The output indicators are really the measurable things that you can count, right? How many solar units installed? How many households served? Time of usage of those appliances. And then by each unit that is being placed, how many liters of kerosene are not being burned every day? And how much CO2 are you removing in terms of emission? And do we have a decrease in household fires? How do you decrease the hospitalization of households because they have exhaled fumes from kerosene inside their huts as opposed to clean solar energy? And of course, problem is not in the output tracking, because that's something we do easily, just like financial reporting. The problem is when you want to infer what has been the long-term outcome of your action and how you link that with a causality effect with the output indicators that you're measuring. That's tricky. That's tough. So right. Just to give you a sense, if I invest in a chain of hospitals in India for 3 states, I can tell you how many poor people I have helped in my hospitals, how many hospitalizations I've had, what is the income level of those people that I've been served, that I've been serving. Now, the outcome is, have I changed the healthcare system in India? I don't know. I think I've contributed to it positively. But there's an intellectual honesty limit to attributing to your sole action and investment the causality and the outcome. We are contributing to it. We can count the outputs. We can report on the outputs. We have a suspicion that those outputs are contributing to the outcomes. Now, are we the only ones realizing this outcome? Certainly not. I don't know if I'm clear, but
yeah, I understand there's a difficulty to quantify maybe how many people have been treated at your hospitals in India, but you don't know how many people got better.
Yes, because if they're returning that, then you have a problem. Let's be serious. If you lend $100 to a micro entrepreneur that need that money to buy stock for its grocery shop, and no one else would lend them money, and if you were not to lend that money, they would not have an employment and they would not care for their family, I think it's impactful. To bring a solar panel in a village in the middle of countryside in Africa that before was chopping wood or burning kerosene for their energy needs, and you provide them with a clean source of energy that is renewable, cheap, can replace those burning kerosene or chopping woods and deforestation, Scott, I think we're having an impact. It doesn't take a PhD thesis to understand that, I think.
How important is proactive technical assistance to your portfolio companies? Yeah. And then what does it look like in practice?
First of all, it's not only technical assistance, it's active management of your portfolio. So we sit on the board of each company in which we invest equity, weekly, monthly reporting from our private debt assets. We visit them very regularly. And when we sit on the board of those companies, we really take part to the strategy decisions and the governance of the company. And we contribute to the best of our knowledge to all the questions that are being raised. We can help with recruiting. We can help with financial discipline. We can help with many different aspects of a business life. And that's what we do on our equity investments. Now, on the external financing, on private debt, of course, as you know, you have less of an interaction and you're not as an internal stakeholder as if you are a shareholder. But given the fact that we have a relatively shorter maturities of lending to those companies. We are in constant interaction with them and we know what they need and we keep visiting them. No, that's our daily job of asset manager. On top of that, what we call technical assistants are usually side pockets of money, usually provided, pro bono. Those are grants that are managed not by us, but by specialized technical assistants, consultants, providers. And here, when we have the benefit of having such a pocket attached to one of our funds, the trick is really to have the manager of the technical assistants be very much in sync and aligned with the fund manager of our portfolio. Because of course you want to use that, grant money for technical assistance to benefit the portfolio companies of your fund, right?
Yeah.
And you want them to address either pre-investment or post-investment weaknesses that you have identified in your due diligence. And that's very powerful, right? But that's what we call technical assistance. That is on top of our daily job of being an active fund manager.
Yeah. But I imagine for the type of deals you're doing, it's just got to be more expensive to do due diligence, let's say, in a small company in Mozambique than, let's say, the same type of deal in a company in Denver, Colorado.
But that's why people criticizing our 2% or 2.5% management fee don't realize. Honestly, if I were just after the money, I prefer to manage $1 billion fund doing $50 million or $100 million tickets in established companies.
Yeah.
And I would still keep my 1 or 2% management fee and I make tons of money. Here I'm managing, Scott, a $50 million fund with a 2.5% management fee, and I'm going in the trenches of Mozambique to lend or to invest $1 million. Yes, it's expensive.
So tell me about the profile of your fund's typical investors.
For Bamboo, what has changed is that before we were really focused on private sector investors, we had the good fortune of having a few pension funds, first funds, very wealthy families as well that were very supportive. We keep talking to family offices and institutional investors, but we have added discussions with, as I mentioned, UN agencies, international NGOs, and actually multilateral organizations. The EU has invested in one of our funds. And in the past, I thought that this would have been a mistake, and today I believe that it's the way to go. So we can address, and again, through blended finance, different pools of capital with the same goal, if you want. There's no exclusion. We can deal with public money and private money and align them in a very coherent way.
I think you have announced recently some kind of partnership or perhaps investment by Palladium in Bamboo. What is Palladium exactly? What's the attraction there for you?
Palladium has been involved in economic development issues and consulting for decades. They're a global company. I believe that they have now over 4,000 employees, consultants. And like anybody else, I suppose, they realize that impact investing is taking off. Not only is impact investing taking off big time, and I think they were on the lookout for an opportunity to team up and possibly acquire a specialized impact asset manager that would be very complementary to their consulting work and advisory work that they're doing anyway. And when we got to meet them, we have now 14 years of experience. We are a privately held company. The first question was, okay, what's the purpose? What's the long-term vision? What are the complementarities and the synergies? And they became very obvious very quickly. With Big Brother being, in the trenches as well in so many emerging markets with so much overlap in terms of interest, but having developed the expertise in many fields, agribusiness, healthcare, energy, becoming their asset management arm was a no-brainer. So we decided that we would engage before we marry. So we have a strategic exclusive relationship with the Palladium Group. They have invested in Bamboo. And as we develop business together, we are truly becoming hopefully integrated in the overall company. And we play the synergies at their maximum. And that's what we're busy doing, specifically in terms of business development. And hopefully in the next few months, you'll see some announcements that will prove that the anticipation of the synergies were actually Correct. I must say it's been 1 year and we are really delighted.
So they're a consulting firm and you're
Yes.
their asset manager, but what assets do they have to manage if they're in consulting?
They manage multi-billion-dollar aid programs for the United States government, the British government, the Australian government, and many other clients. When USAID wants to develop a program in Peru or in Kenya or in Mozambique or in Cambodia, they need people to manage their aid programs, their grants programs. And Palladium today manages multi-billion aid programs. And by doing that, they are at the forefront of the key problems of those countries. Yeah. And they have many teams on the ground. They have in-depth knowledge of the local setups and bottlenecks and needs. And one of the solutions to some of those problems is actually investing for impact. And I believe that we are providing the instrument that will allow them and us to do that at a bigger scale.
Are the capital markets, in your opinion, really sufficient to deliver the needed change? If this 2.5 trillion, if you believe in that, we got a huge gap. Will this ever be resolved?
Scott, I'm always suspicious of the big numbers, regardless of where they're coming from. I cannot make sense of that. It's big. And if you say it's trillion, 2 trillion, 3 trillion, whatever, I don't know how that has been calculated, and I frankly don't care. All I know is that there is a big problem, and we have big problems in the world, as we've seen during the summer, all over the globe. And if people don't wake up to that reality, then we're all going to die. They're very simple. Now, it pales in comparison to the target. Yes, we are doing what we can, the best we can, and how quickly we can, by being true to our mission, which is helping social entrepreneurs solve real problems of real poor people in real difficult markets by investing as best as we can. Nobody prevents anyone from launching another bamboo and doing the same thing. So I'm bringing my contribution to that.
You're doing your part.
I do believe that we are doing our part as best as we can. And what I'm really saddened by is really that people that do have the means of accelerating that movement are actually not doing it. When you look at the sovereign wealth funds and those huge pension funds and that hide themselves behind their fiduciary responsibility to their pensioners or future pensioners, I'm tempted to say your fiduciary responsibility to your future pensioners is that there's still a world they live in 50 years or in 40 years. So stop looking at purely the financial returns and the risk of avoidance and start investing in true scalable solutions, for God's sake, for your pensioners. That's your fiduciary responsibility, not chasing the 20% IRRs that everybody knows you're not achieving anyway.
What do you think technology could enable over the next 10 years, say, in the target industries that you're working in?
Technology is increasingly becoming central to impact investing. I was mentioning this company, Solar Access Company, working with artificial intelligence, remote control batteries, mobile wallets, mobile payments, pay-as-you-go system. They would not be able to do that without technology. Technology is bringing you two things, Scott. It's bringing you the accessibility to the service, right? And by the way, at times of COVID, we've seen that telehealth, telemedicine could be extremely useful in many of those markets, as opposed to the primary healthcare posts that everybody talks about and that everybody has tried to develop over time. And the second thing it brings is affordability, because usually if you get to scale, you can price the entry point, the price point quite low so that it becomes attractive and feasible for people. So if you have accessibility and affordability thanks to technology, that's the way to go in access to energy, in access to education, in access to healthcare, and in access to finance. I think we are at the very beginning of something I cannot even imagine, but technology will be the driving force of the scalability of impact in many sectors. I'm convinced of that. And that's why we're launching now 2 tech for impact funds in Latin America and Africa, because we see that this is the next wave to scale impact. And those are potentially great investments as well, financially speaking. And if you ask me, why are we so excited about the access to clean energy and solar energy in off-grid markets? It's because once you have energy, you can have access to content. You have access to the World Wide Web, and suddenly you unlock populations and you open the world to them, and you open entrepreneurship, knowledge, participation, inclusion, and that's fabulous. And once you have opened that access, there's no way back. And it's a very positive snowballing effect on the younger generation.
If you had to name the single most important challenge right now in the sustainable impact investment space, what would it be?
Impact washing. Lack of transparency from many players, because you have the danger of throwing the baby with the bathwater. Because if those guys cast doubt on what we're doing, then this is very damaging.
What do you know now about impact investing that you wish you knew when you launched BlueOrchard maybe in 2001, or when you launched Bamboo Capital in 2007?
The role of technology. I didn't see it coming. I should have. But if we had identified way earlier that technology would be the driving force for the accessibility and affordability of our work, we would have specialized in that very early.
Back then, what did you think was really important then that now you know isn't?
It's a partial mistake. We believe that what we were trying to do could not have any relation to philanthropy or could not have any relation to the traditional corporation work or social work. And we wanted to stay clear of that. Didn't want to talk to development finance institutions, to NGOs. And we felt that being pure private investors would go a long way towards our potential scale up. And when I see now the potential of blended finance and actually a way of not excluding any sort of capital, but combining their strength into coherent structures and investment strategies, I think that was a big mistake. Now, of course, since we did that, we are now able to bring to the table the private investor relationships that we have cultivated over years, and maybe we would not have been able to develop those if we had appeared as being social tree huggers. But in retrospect, I wish we had embraced those collaborations earlier to learn from them.
Can you describe to me an example of an investment that at the time you made it, you were convinced that it ticked all your boxes, but in the end it went pear-shaped or it didn't work out? What was a lesson learned from that?
There are a few. But let me think. Okay, maybe an investment I was really proud of and I was really believing in was an investment we made in India in a chain of primary care hospitals. I really was admirative of the CEO and the founder, really charismatic leader. He had founded, at the time we invested, 4 hospitals in a state in India, and 2 of them were break-even. The 2 others were about to go break-even, and we invested what was at the time a significant amount of money to help him scale that business. And when you're too eager and too ambitious, then what happened with that company is that they started, launching new units, new hospitals across different states too quickly. And at the time, we felt that the footprint was a driver to the value of the business as opposed to the per unit economics of the business. And that was a huge mistake, because in the end, the follow-on investors and buyers will look at the unit economics as opposed to the footprint. And that was a mistake. The second mistake we made up there, not a mistake, but a lesson learned, is that you can have a charismatic leader and founder if this guy is not followed by a very solid middle management team. Whoever he is and whatever his ideas and however bright they are and fantastic they are, it's not going to be put in practice. So the execution and the solid middle management of a social company, even if it's led by a fantastic charismatic leader, is essential. And that's a mistake we've made as well.
And now the converse of that, could you describe an investment that either you were skeptical of when you went into it, or actually you passed on it because you didn't tick the boxes or you didn't believe in it, and in the end it turned out way better than you thought and you were really happy you invested, or that if you passed on it you wish you had? And what was any lesson learned from that?
Many of them, again. Let me take the example of a financial inclusion company in Mongolia that was early in the development of the first fund of Bamboo, and we got to know that the management team and the CEO specifically and founder of that company, which became a bank, by the way. And again, very charismatic, very powerful leader and business entrepreneur. And they were part of a network of microfinance companies, and that's how we got to know them. And they were looking for capitalization of their company. And the goal was not only to do microfinance banking in Ulaanbaatar. The goal was to also provide financial services to herders in the steppes of Mongolia. And I was thinking, if we do that, frankly, that's just mind-boggling, because I cannot understand how he's going to do that. I understand the urban approach, the urban center approach, but frankly, that one, let's see. And actually, again, strong execution capabilities, very disciplined approach, very inventive and innovative ways of serving those populations. They did it. They really did it. They became the fourth largest bank in Mongolia now, and the exit we had there by far overshoot the 20% IRR target.
What was the lesson learned there?
For me, the lesson learned is that the key, and I'm not going to say anything new, but the key is really on the execution capability and strength of the senior team you're investing in. And regardless of the difficulty of the environment that you can see, if those guys are from the region and know intimately and are innovative and bright, they can make it happen. And if they are, of course, honest. And so that's why I'm not turning any deal anymore just because on the assessment of the environment or in the country, except if you tell me, well, I'm going in a war zone. But there are many challenges and many solutions that can be brought to difficult problems in difficult environments if you have the right team. And that's a lesson that I learned, that's that I'm not scared anymore by any sort of country situation, as long as I know that the team knows how to behave and to adapt and to innovate and work hard to deliver. Now, then they succeed or they don't succeed, that's another story. And here they succeeded dramatically. I mean, they really succeeded. But that's the lesson I learned.
If someone wants to get into the impact investing space, how would you advise them to get in the business?
Well, I would say, first of all, know yourself and know your strength and your capabilities. And that's number one. And number two, be genuinely focused on what you like doing. There's nothing worse than doing something because you believe you have to do it, but effectively you don't enjoy it. And in the field of impact investing, there are many ways you can bring your piece, right? There's asset management, there's advisory, there's consulting, there's actually becoming an entrepreneur yourself. It's joining an entrepreneurial team. There's a broad range of entry points into the field of impact investing. You should do what corresponds to you, before your brain to your heart, and then your brain, and then your skills. And I will repeat a well-known slogan: just do it. Don't wait. Just do it. There's no downside. Literally.
If you could easily grab a glass with anyone and sit down and pick their brain to find out what they're doing, who would that be?
The one conversation I would love to have one day, and I was never able to do that, is with the CIO of a sovereign wealth, and just understand from him or her why they're not doing more in impact, and how they are not capable of being innovative and risk-taking, even for a micro fraction of the assets they had under their management. I would love to hear them and their justification as to why they are not more risk-takers and proactive in that. I think it's as a general category, the minute you start managing over $500 billion and you tell me that you put the whole institution at risk because you test something on 300 million, I have a hard time believing that. And I have a hard time understanding why they're not doing it. I would love to understand that.
All right. Jean-Philippe, this has been really informative for me. I've learned a lot, and you've been very articulate, been very gracious with your time. It's amazing what you've been doing. You've committed a whole lot of years to pioneering, first microfinance, then impact investing in the private equity space, and it's been impressive what you've accomplished, and I wish you nothing but the best for the future.
Thank you, Scott, and I hope this can help a few people get at least some sort of ideas on what we're doing and what is impact investing. And success for me is this interview is if at least I spark some ideas or some desires in people that will either read the book or listen to this interview. And I think it's great, and something we have not touched upon, and maybe I should have mentioned when we talked about the type of investors. There's a regulatory bottleneck or that is to me a pity, and that's the access to the retail segment for specialized impact investors. Because honestly, I believe that we would be managing more money if I were able to collect €100 investment sizes into my investments funds, and having to go to the ultra high net worth individual institution investor, and this regulatory system that protects the retail investor from risky funds is something that I feel is a huge bottleneck on the growth of the impact industry. Because you know what? When I talk to friends of my young sons, they get it immediately. And even if it's 50 francs, they would invest. They would actually do it. And it takes forever to convince the gatekeeper of a family office that you're doing the right thing. It takes me 20 minutes to have the younger Z, X, or Y generation, I forgot the last name of them. That's the way to go, because they were born in a world that is having those problems, and they know that they need to do something about it. And the new generation of wealth owners are getting it much faster than the older generations. And if we were able to access those younger generations more easily and broadly, and even on a retail basis, I'm pretty sure this would be a landslide.
This has been great, very informative. Thanks so much for spending the time.
And thank you for reaching out and for giving me the opportunity to share a few thoughts. So thank you, Scott.
If you enjoyed this podcast, please do me a favor and hit the like button and subscribe to receive future episodes. You can find more interviews, articles, and information on sustainable and responsible investing at our website, sri360.com. If you enjoyed this interview and you would like to read more lessons learned from world-class SRI investors, get yourself a copy of my book, Sustainable and Responsible Investing 360 Degrees. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 Degrees is now available in hardcover, ebook, and audiobook format wherever books are sold.